Analysts project that an improving macroeconomic environment fueled by fiscal and monetary stimulus will shift capital out of gold and back into cyclical assets. The forecast suggests a gradual reversion below the 3,000 per ounce threshold by late 2026, with prices falling as low as 2,500.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Morning, everyone. I'm Vince Lanci. It's Thursday, 7:57. This is the market rundown. Your screen, top center, audio. Citi sees gold's last hurrah as growth outlook improves. That's what we'll be focusing on today. There, is that better? And then you can see the rest of the stories there, and we have a lot more coming up. So let's get going. There's the story we'll be focusing on. 10-year-olds are unchanged. The dollar is unchanged bid up 5. S&P 500 59.51 down 30. The VIX is 21.53. Pretty strong. Interesting. Gold is 33.71 up only 2. It should be up more given what's going on. Silver is down 37. That's expected. Risk off. Copper 478 down 4. WTI up $1.42. Natural gas 389. Bitcoin down a little bit, but really not strong. Platinum, palladium both down. Gold, silver is up. Soybeans, wow. Wheat up 25. Now, that registers as 446. I don't know if that's wheat related or crop related, but that's a huge move. Okay, so if you look at that summary of those markets, everything there tells you in one way or another that there's more geopolitical unrest. Gold's not high enough. That should tell you something. Maybe there's some selling in gold lingering around. Silver is doing what you'd expect it to do. Copper's doing what you'd expect it to do. WTI, what you'd expect. Natural gas marches to its own drummer. S&P 500 down, not horrible, but down. The VIX up. This could also be in part a comment on Powell's hawkish vibe. So I'm going to combine these. Geopolitical risk is being looked at closer. Oil's up, and gold's up, and Powell's throwing water on the rate cut scenario. I don't know, but given that a missile landed in Israel, causing extensive damage to a hospital, and the IDF has begun bombing reactor targets, an inactive reactor that they have. So, as we said, this is not going away anytime soon. It won't go away until it's done. And I think we're moving towards regime change. Okay, so let's go to the actual story. Where is it? There it is. All right. We put out an audio note accompanying this story. Now, the last couple of days, you've been seeing the mainstream media is loving the Citi says gold's going to sell off thing. And so we want to cover that. It should be covered. It's meaningful. Citi sees gold's last hurrah as growth outlook improves. After a remarkable 3-year rally, Citi is calling time out on gold's bull market. In their latest commodities outlook, analysts project that an improving macroeconomic environment fueled by fiscal and monetary stimulus will shift capital out of gold and back into cyclical assets. The forecast suggests a gradual reversion below the 3,000 per ounce threshold by late 2026, with prices falling as low as 2,500. Now, our audio note gives that context. So, to give you some history, I think that's my next paragraph. Yeah, there we go. Citi expects additional rate cuts ahead and believes these will prompt sideline capital to flow into the broader economy rather than into gold, while also suggesting that geopolitical risks are nearing their peak. Goldman, we note, pushed back in their own analysis, which we'll be sending out this weekend, reaffirming their position. Again, more on that this weekend. And full context is provided in the attached voice note. The context involves Citi had called for aggressive rate cuts in July of last year. Citi had, and they were wrong. Citi called for oil to be significantly lower, and it was very well timed, and they were right. And now Citi is saying, although gold benefits from a weaker dollar, the risk on environment is about to come back. We'll see. Now, if that's true, and I want to assume that it is true, I want you to assume that they're right. Then this report 2 months ago is even more relevant. Gold miners, Citi makes the fundamental case. The report we wrote then is probably the best of the bunch here from a macro point of view. They argue, and we write up, that at the end of the day, it is time for gold miners to begin to track gold price just like oil and copper producers do. It's a fundamental case. We would add stock portfolio managers like fundamentally driven market analogs with a target, specifically when their Mag 7 stocks are cracking. So if you take those reports as bookends, Citi is saying the economy will do better and money will start to flow out of gold over time. The trade is to be short gold and be long miners. If you believe they're right, if you believe they're wrong, the trade is to be long gold and long miners and short regular stocks. But that's the idea. So I think it's the first bank to make such a comment, and it came from, I think his name is Max Layton, basically their chief investment officer. So it's not regular research yet. Let's see what happens. We've already seen Goldman immediately push back and say, this is our target. We're sticking by it, and we're sticking by it. 3,700 by the end of the year, 4,000 by Q1 2026. So you're starting to see some serious divergences here between the banks. The question is Citi ahead of the curve, or is Citi just outright wrong? We'll see. That report was sent out this morning. The full analysis is in that premium post entitled Citi Sees Gold's Last Hurrah as Growth Outlook Improves. Related posts, there are a bunch, but we're going to show you three right here. There's the post we discussed, Silver Surge and Fed Day. And yesterday we covered, I'm going to scroll this up a little bit. Yesterday we covered the Fed before in two posts, one to the premium, one to founders. And we also covered the Fed aftermath, giving you a quick analysis of it in our Gold Fix daily chat, which is unlocked for all. You click on that, you'll see it. And that goes out on Substack. Moving on. Coming soon, tomorrow and over the weekend, Goldman doesn't back down on the $4,000 gold call, as we just iterated. Founders will get an early look on some gold, platinum, and silver analysis that we've seen from UBS, Goldman, and another bank. I'm not sure who it is, but nothing surprising there. But I think it's important in context. And then we have a chart deck, the BOA client survey, which is always visually appealing and gives you a good idea of how the world views institutional managers view things. And right now, they still think gold, to give you an idea, they still think gold is the most crowded long trade. And finally, the dollar's decline, that's a think piece, is no longer temporary. And we're going to go into that in the context of gold and the dollar and de-dollarization worldwide. Next, data on deck. Today's Thursday. Today is Juneteenth. Beautifully placed after Father's Day, so nobody really cares about it. But everybody who has a woke agenda feels good about what they do. That's my editorial comment on Juneteenth. 8:30 a.m. is Friday, the Philly Fed survey. And I think that's pretty much it. But I do want to pull up some charts because in the spirit of Citibank's analysis, I pulled up some charts to give you an idea. Here's gold versus silver since roughly 22, right? That's when things kind of changed. Well, silver has tracked gold, but at a smaller beta. Question is, if gold drops, will silver rally or will silver also get punished and just less? I don't know yet. I have an opinion. It's not worth mentioning yet. This one I feel pretty strongly about. Oil versus gold. I believe that the world's commodities are going to rise against gold. Gold will set the tone for the rest of the commodity world to rise in general. And I think oil is the easiest one to see that. And so if gold's going to stay at 3,000, then oil's got to catch up because we're pricing commodities. We're pricing commodities in gold in half of the world now. And so I think that that will close. I'm not sure yet, but hey, so far so good. Again, industrial commodities, right? So we move to copper. Copper has been also correlating with gold, but even weaker than silver. And that's interesting considering it gets all the news on the industrial side. I think copper's got some headwinds going against it that are in the news, but ultimately the AI data centers call for copper demand, and I'm surprised it's not overperforming. I'm surprised it didn't rally more when silver rallied. You follow? And I think that's the point. Silver is just a crowded short that's covering. So let's see what goes on there. But I think copper would appreciate against gold as well. And finally, two markets. The purple line, yeah, is the U.S. stock is the mining sector, and the green line is the stock market in general. So if you look at gold compared to say miners, you could see that miners are now tracking gold, even outperforming at moments, but they still have a ways to catch up. Stocks are back on course. So if you believe in Citi, you're short gold and long miners. If you really believe in Citi, you're short gold and long stocks. We believe that if you're bullish on the economy, when the Fed eases, if the Fed eases, you buy miners. If the Fed doesn't ease, you buy gold. Stagflation, you buy gold. Recession fears or Fed easing, you buy miners. In the meantime, we're long gold and we're long silver. We're taking it on the chin today. That's it. I'm Vince. I may be off tomorrow and I may be off next week. But between now and then, see you later.
Well, thank you for joining us here on the Arcadia channel for another episode of Morning Markets and Metals with our dear beloved Vince Lancy. Sure hope you're doing well out there. Obviously, I know these can be some stressful times. God forbid what it's like for the people living in these countries, Iran and Israel. And we'll mention that so far our dear friend Rafi is doing well and safe. And we will be keeping him in our prayers, and just hope that you're also doing all right out there at home, handling what can often be heavy news in chaotic times in the world. But fortunately, that's why it's really nice the way we have a chat going here each morning and bring people together a little bit as we watch the gold and silver markets unfold. So with that said, before we wrap up, I did just want to thank Fortuna Mining, who has had quite a year and also kindly brought us this morning's show with Vince. And last few weeks alone, they had an announcement that they completed a strategic investment in Awale Resources, which is increasing their footprint in Cote d'Ivoire, allowing them to pick up assets in certain sections of the still somewhat depressed mining equities markets. Of course, they also continue drilling at their Diamba Sud project that they got from Chesser Resources, which is in Senegal, and where back in a month ago, they got 8.6 grams per ton over 13.6 meters and continue to have drilling success there. And of course, especially with the combination of their success at their Seguela mine, as well as the elevated gold price, which has stayed in that range, fortunately, that's really filtered into their free cash flow. And here's a quick word from the CEO of Fortuna Mining, Jorge Ganoza.
We went from record to record. In Q4 2024, we had record free cash flow of $96 million. And into Q1 of 2025, we reported, as pointed in the news release, record again in free cash flow of $111 million. That means we increased our free cash flow margin quarter over quarter from 31% to 38%. That's margin of free cash flow over sales.
Well, thank you to Jorge. Thank you to Fortuna for their involvement in the show. And most of all, thank you at home for watching. Sure appreciate you being here. And with that said, we will wrap up for today. But we'll look forward to closing out the week with you tomorrow.